I was surprised to learn the other day how many people do not understand how tax brackets work and how to calculate your taxes. So in this video, I'm going to walk you through a basic calculation so that you can understand how tax brackets work. Now, the tax brackets are issued every year. They are usually adjusted with inflation, and also they're adjusted whenever Congress decides they want to make a change to the tax code. So we're going to use the 2024 tax brackets for our calculation. All right. Our assumptions are the gross income, the total income that you have, regardless of your filing status, is $100,000. And so how your tax is calculated is based upon your filing status, whether you're single, head of household, or you have a joint return. If you are married filing separately, then you're going to file under the single filer tax bracket. All right, so let's walk through the calculation. Oh, forgot one thing. So this is your standard deduction. So your standard deduction is a deduction that everyone gets based upon their filing status. It's automatic. You can itemize, and I would only itemize if your itemized deductions exceed your standard deductions. Because if you itemize when your standard deduction is greater than your itemized deduction, you're actually hurting yourself. But okay, so let's do the calculation. So if you have $100,000 as your total income and you're a single filer, then we take the $100,000 and we reduce your income by the standard deduction. And now your taxable income is $85,400. There are other things that we can do to adjust your income to get to a lower taxable income. That's where the term adjusted gross income comes from, because there are other factors that we can use to get your income even lower. But again, the point of this is just to do a very quick calculation so you understand how the tax brackets work. Okay. At $85,400 of taxable income, that puts us in the 22% tax bracket, because your taxable income falls between $47,150 and $100,525. That does not mean you're being taxed at the 22% tax rate. That means that's the bracket that your income falls in. And here's how we do the calculation. The first $11,000 of your $85,000, your first $11,600 of your $85,400 is taxed at the 10% tax rate. Then we take the bottom of the next bracket minus the 11,600 you were just taxed at. This amount, that difference, is taxed at the 12% tax rate. Now we've landed in the 22% tax bracket. So we're going to take your tax minus the bottom of the previous tax bracket. And this is the amount that is taxed at 22%. Now your total tax is going to be $13,841. That's how the tax brackets work. It's really that simple. So let's do this for head of household. $100,000 minus the standard deduction for head of household. Now your taxable income is $78,100. We are in the 22% tax bracket as well. So our taxable income, let's put this here. So the first $16,000 is taxed at 10%. Then we're going to take the difference between the bottom of the two tax brackets. That difference is taxed at 12%. So we're in the 22% tax bracket. We're now going to subtract the 78,100 minus the bottom of the next tax bracket. And that gets taxed at 22%. Total tax, as you can see, it's lower. So this is single. And this is head of household. All right, married filing jointly. We're going to take the 100,000 minus the standard deduction. So our total tax is 70,800. That puts us in the 12% tax bracket. First $23,200 is taxed at 10%. Then we're going to take the bottom of the previous bracket minus the income. Oh, did it backwards. That gets taxed at 12%. Married filing jointly, tax. And that is our married filing jointly tax. So that's how the tax brackets work. Okay, what about capital gains tax? And this is long-term capital gains tax. Long-term capital gains is for things like stocks that you've held for more than a year. Short-term capital gains, you're going to get taxed at your regular tax rate. So what we're talking about is long-term capital gains, because what you hear is, the Warren Buffetts and other people who trade stock, they don't pay as much in tax as other people do. So how does the long-term capital gains, tax work? Unlike the tax brackets for income, we don't say, hey, your taxable income is 85,000. So then you're going to pay 15% in tax. That's not how it works. So let's assume we have a capital gains of $10,000. So our capital gains is $10,000. That does not mean because your capital gains is less than the 15% tax rate, you're going to pay zero tax on the capital gains. What we do is we take the capital gains amount after we've calculated the tax, after we calculate your income, and then we add that $10,000 to your income. So this taxable income is $85,400. So we're going to add the $10,000 in capital gains income to the 85. That puts you at 95. So that puts you at a 15% tax bracket if you're single. We do the same thing for whether you're married filing jointly. So all you really do is you're adding the $10,000 in capital gains. You're adding it to the top of your taxable income. And so when you add, so we'll do for single, 85,400, you add those two together, that's your total income. So this is the number, the 95,400 is the number you use for determining if you're going to end up paying, where you fall for the capital gains tax calculation. So that's how that works. So in this example, you're going to pay 15% in capital gains, 15% times 10,000 is 1,500. So then we would add this $1,500 in capital gains tax to your income tax year in each of these categories. That's it. Pretty simple, pretty straightforward.